Jordan, good to see you. We have a timely topic, how to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are finally coming down. That means it's time to rethink how we are investing. But before we get into that, can you explain why the Fed is now lowering rates?
Well, the Fed's trying to control, inflation and look at the economy. And when inflation looks to be kind of stabilizing, they don't know 100% how to time it perfectly, but they're thinking, hey, let's try to be in line. And when inflation comes down, now we need to start lowering the rates. The economy stabilized. If we look back, a few years ago, interest rates jumped so quickly. Now they're trying to have a soft landing and slowly lower those interest rates, aligning to inflation and the economy.
I'm glad you brought that up. Everybody wants that soft landing. So, how do we know if we have avoided a recession?
The question I like to ask is not did we avoid a recession, but have you been impacted by the economy or a future recession or a past recession? And that's what I think the question needs to be, because we don't know if we effectively avoided a recession until years later we look back at the data. But what I do know is if we can control the client's outcome and make sure that their personal finances are not affected, that is the solution. That is what we try to control. We can't control the recession for the US economy if there is one or will be one in the future, but we can control what we do. And that's what we try to do for our clients.
hmm So, now let's talk about investing when interest rates are on the decline. What's the biggest difference?
Yeah, so a lot of that, I call it lazy money. That money just kind of sitting on the sidelines, drinking a pina colada by the beach, not making you a whole lot of interest. But maybe the last year you made 4 or 5% because interest rates are high, right? Money markets, maybe CDs, maybe that high yield savings account. Those are going down now. You might have already seen that. So those interest rates are going down. That means those lazy money accounts aren't making what they used to be.
All right. So, then let's talk through what specific investments we should perhaps be considering right now.
Yeah, everyone's so unique and different. And a lot of people equate that if you take a lot of risk, you're going to get a lot of return, or if you take no risk, you get no return. Well, there's a lot of things out there for especially that lazy money that we just talked about, that you can take very little or no market risk and still make very competitive returns. Some things we show clients is kind of a unique strategy that keeps that money tax deferred, because those CDs, or I like to call them sometimes certificates of disappointment, because that money you make, then you're paying taxes on it, which diminishes your net return. Those are going to make you right now maybe 4%. Okay. Well, you can do money in a tax deferred account, and a specially designed, technically life insurance account that it grows tax deferred. You can make 5 to 15% and still take no market risk. Now, that's for some people. Some people, maybe they need income and they want to get income from their investments. They might look into structured notes or bonds. Structured notes are paying between 10 and 15%, and that pays on a monthly basis. Bonds can pay out, if you have a diversified bond portfolio, pay out monthly. And when interest rates actually go down or continue to go down, that actually inflates the price of your bond portfolio. They have an inverse relationship. Interest rates go down, bond portfolio goes up. So those are some things that we look at. Obviously, long-term equities, a plan, diversification is key. But especially that lazy money that's on the sidelines, now those interest rates are coming down. Now we got to look at how do we look at other alternatives to maximize our growth, but still keep minimal risk.
Yeah, absolutely. Well, Jordan, if somebody has questions about making sure they are properly diversified, no matter what the Fed is doing, what's the best way to reach you?
Yeah, they can call our team at 847-499-3454. And we look forward to providing financial leadership and giving us some good advice.
Great. Jordan, thank you.
Thanks, Aaron.